Türkiye has raised interest rates for a seventh straight month as it continues its battle against inflation. The central bank increased the benchmark one-week repo rate by another 250 basis points to 42.5%, taking the total tally of hikes to 3,400 basis points since June. Türkiye shifted its economic policy with the appointment of a new finance minister and central bank governor after President Recep Tayyip Erdogan secured another term in office in late May. And new fiscal policies have already started bearing fruits, as rating agencies including S&P and Fitch have upgraded the country's outlook from negative to stable. This could pay off with the continued return in foreign investors in 2024. Analysts expect the country's domestic sovereign bonds to be one of the top trades in emerging market fixed income next year, at a time when major central banks are set to begin their monetary tightening. Let's get more on this now from economist Taha Arvas. He's a professor of finance at Boğaziçi University and joins me now from Istanbul. Thank you very much for being with us, Taha. Right, so another hike from the central bank. How close are we to the terminal rate?
I think we're very close. I think either this is it, or we may see one last small hike. And I think we're at the rate, because while we see that some other nations are talking about potentially continuing tightening, we see that the Federal Reserve in the United States has signaled that it will begin to ease, which is good news for countries like Turkey. So I think at this point, the Turkish Central Bank will either stop hiking or will do one last small hike.
Interesting. What's your outlook then for the monetary policy for next year? As you said, analysts have said the disinflation period, right, will start from March or April and maximum May. What do you think the central bank will do then at that time?
I mean, what we see here is that there's a serious increase in interest rates. So there is going to be there already is a slowing down of the economy. And with levels this high, I think we'll see a pronounced period of disinflation and demand destruction, frankly. And as a result, we may see inflation come down very quickly in the coming months. And maybe by the end of the year, we may be in a period where that's enough. We'll see what happens. I think the Federal Reserve has penciled in 3 rate cuts for the United States. I don't think we're in the rate cut scenario for Turkey yet, but you never know. If the slowdown happens fast enough, then perhaps.
That's good. That's a very positive projection, as it seems. But what's the likely impact on the economy of keeping such high rates? We're talking potentially 45% interest rates for a prolonged period of time on the economy.
Right. So it's a very delicate balance here, what we see the central bank trying to do. I mean, the point is to bend without breaking. Obviously, the worst case scenario would be to increase rates so high that you see massive layoffs, that you see companies going out of business, because it's so much more difficult to reignite a fire than it is to just have it dwindle down a little. So do I think that damage is done? Will there be long-term damage to the economy now? I don't think we're there yet. Obviously, that depends on how long we stay where we are and what the terminal rate will be. We see disinflation happening already. If we see continued progress in the coming months, then I think it's possible that we could be back to normal or beginning even cutting in line with what the Federal Reserve is doing. And if we see that rate cuts in the United States go down, if the rates go down fast enough, then foreign investors will be looking to invest elsewhere, and Turkey would be one of those targets, which would be great news. Would have added investment into Turkey, which could help bolster the currency, which would also help towards disinflation.
Right, and on this very point, one last question, because at this level of rates, as you say, sentiment around Turkish government bonds seems to have improved a lot. Will we see more inflows on the bond market, the domestic bond market? And if yes, what would this mean for the lira stabilization next year?
Sure, I think that's definitely in the cards. I mean, one of the things that the central bank is trying to do, it appears, is not an appreciation of the lira necessarily. We see the increase in foreign reserves and gold in the central bank increasing very quickly. So you don't want to have an appreciation of the Turkish lira too fast, so that'll lead to more imports and further inflation. So it's a delicate balance, like I said. But if there are major interest rates cuts in the United States and elsewhere, foreign investors will look for alpha anywhere they can get it. Will look for return on investments. And with rates so high in Turkey, you may see people engage in the carry trade and come to Turkey to invest in Turkish government bonds, which will ultimately help decrease interest rates.